Welcome to the Deep Dive. We're here to break down the latest market moves and give you that knowledge edge. You know, the Kenyan financial scene, it's always moving, always changing. So today we're diving into some fresh financial reports, market updates, and key news highlights. We really want to get a handle on the forces shaping the market right now. Our mission basically is to cut through the noise, spot those key bullish and bearish trends, figure out what's driving them, and maybe even offer a few practical ideas for navigating this landscape. Okay, let's unpack this.
Yeah, absolutely. And what jumps out straight away, looking at the data from May 21st, 2025, is just how, well, nuanced things were. Take the Nairobi Securities Exchange.
Yeah.
The NASI and the NSE 20, they saw small gains, right? But then the NSE 10 and NSE 25 actually dipped a little. So
Yep.
it's not like the whole market was moving in lockstep.
Exactly. And that slight uptick in some indices, it gets even more interesting when you look underneath at the activity level. The equity turnover, the actual value of shares traded, was way down compared to the day before. What's that telling us? Does it suggest maybe investors are feeling a bit hesitant?
I think that's a fair read, yeah. Lower turnover often signals a degree of uncertainty, People might be holding back, waiting for clearer signals before making big moves. And if you tie that into the foreign investor activity, there were actually net sellers on the 21st. That reverses the inflow we saw the previous session. That could definitely feed into that cautious feeling.
Right, a net outflow. So international money pulling back on balance.
Precisely. So headline indices might nudge up, but lower volume and foreign selling.
Yeah.
It paints a more complicated picture, doesn't it?
It really does. Okay, so let's switch gears to the companies that did have a good day, the top performers. We saw names like EGADS, Liberty Kenya, HF Group posting some decent gains. What was behind these bullish moves?
Well, there are always a few things at play. Of course, you had some big names like INM Group, EABL, BAT Kenya.
Mm-hmm.
They did well, and that helps lift the indices. But the analyst reports give us a bit more insight, like AIXYS Africa's BUY rating on Safaricom. That's quite compelling.
Safaricom, right. What was their reasoning?
They're pointing to things like expanding connectivity not just in Kenya, but Ethiopia too. Plus, a growing customer base, diverse products, that regional push, and, importantly, continued investment in tech. It suggests a company really building for the future, capitalizing on that whole digital expansion across the region. It makes them kind of a bellwether.
Absolutely. That does sound like a strong case for growth. And Safaricom wasn't the only one getting positive attention, was it?
No, Kenyan also got a BUY recommendation. And interestingly, it was linked to shifting weather patterns.
Weather patterns, how so?
Yeah, apparently the changes are favoring their geothermal energy production. It's a good reminder that these big macro factors, like climate, can create some unexpected boosts. Even though their thermal operations are flagged as expensive, the growing reliance on geothermal gives them a significant edge.
That's fascinating. And ABSA Bank Kenya, also a BUY.
That's right. Driven by their digital loan products, which seem to be boosting short-term lending quite effectively, and their subsidiaries are contributing nicely to revenue diversification and overall profitability. So real, tangible performance drivers there.
And it wasn't just analyst ratings pointing upwards. We saw some strong Q1 results too, right? From BK Group and Family Bank.
Yes, exactly. Both reported solid growth pretty much across the board. Net income, assets, loans, deposits, equity. BK Group even managed to get their non-performing loan ratio down, which is always a good sign of health in the loan book.
Lowering the NPL ratio, yeah, that's definitely positive.
And Family Bank showed really strong growth in net interest income and profit. So, yeah, pockets of real strength in the banking sector.
Okay, so specific banks doing well. What about the bond market? We saw a mention of increased turnover there.
Right. Secondary bond market turnover picked up. That usually points to more activity, more liquidity. Could be investors shuffling portfolios, maybe reacting to interest rate expectations, or just finding opportunities in different bonds. It suggests active trading.
And finally, on the positive side, the U.S. dollar weakened slightly against the shilling, though it was stronger elsewhere.
Yeah, slight easing against the shilling. That could offer a little bit of relief for importers, maybe consumers too. But the fact it gained against the euro and yen just highlights how complex currency moves are, driven by much bigger global trends, really.
Okay, so that covers quite a bit on the upside. But inevitably, there's the other side of the coin. Let's look at the underperformers, the bearish trends. Uchumi, Express Kenya, Unga Group. They were among the biggest losers on the 21st. Any common threads there?
Well, often the biggest percentage losers are facing very specific company issues. Could be operational headwinds, financial struggles, tough competition in their sector. Without digging into each one specifically for that day, it's usually those kinds of internal or sector-specific pressures driving those sharp falls.
And we also saw some of the larger caps weighing the market down. Co-op Bank, Stanbic, Stanchart, Equity. Now that's interesting given the good news from BK and Family Bank. This split in the banking sector is quite stark.
It really is.
Yeah.
And it hammers home that point. You just can't paint the whole banking sector with one brush. Some are clearly navigating the environment better than others. It forces you to look really closely at individual banks and their specific situations.
And speaking of specific situations, Nation Media Group got a sell rating. Reasons cited were falling print sales, more competition, and delayed dividends.
Yeah, that's a tough story, but not entirely surprising, is it? It reflects the huge disruption traditional media is facing everywhere because of the shift to digital. Plus, more players in the media space just makes it harder to maintain profitability and keep shareholders happy with dividends.
We also saw hold ratings, but with downsides noted for HSBC and Expedia. Expedia's was linked to a potential tourism slowdown.
That's right, an anticipated tourism recession. And that's significant because tourism has such big knock-on effects, doesn't it?
Absolutely. Hospitality, transport, all sorts of related services feel the pinch if tourism slows down.
It could definitely put a damper on broader economic activity in areas that rely heavily on it.
Then there was PepsiCo. A BUY recommendation, but somehow with a downside indicated. How does that work?
Yeah, that sounds a bit contradictory, but it usually means the analysts see good long-term potential, solid fundamentals, growth prospects, but they might think the current stock price is a bit high compared to their immediate target, or maybe they see some short-term headwinds. So positive long-term, but maybe a dip near-term.
Okay, that makes sense. Then we had those profit warnings from the tea sector, Capturua Tea and Williamson Tea.
Yes, both projecting earnings after tax to fall by over 25%. That's significant.
And the reasons. Low tea prices globally due to oversupply and the strong shilling making exports tougher.
Exactly. It's a clear example of how vulnerable export-heavy sectors, especially commodities, are to global prices and currency swings. A really challenging picture for tea right now.
And mirroring that mixed banking picture again, while BK and Family Bank did well in Q1, Stanbic and Standard Chartered reported declines in key areas like net interest income and net profit.
Yeah, it just reinforces that need for selectivity. Different banks, different pressures, different results. Stanbic and Stanchart seem to be facing their own specific hurdles right now.
And finally, on the bearish side, foreigner activity. Both buys and sales decreased, but the net result was bigger outflows.
Right, circling back to that earlier point, it does suggest that international investors on the whole were pulling more capital out than putting in. Could be risk assessment, could be global uncertainty, lots of possible factors.
Okay. So we've looked at the winners and losers, the ups and downs. Let's try and synthesize this a bit. What are the key companies or sectors really driving these shifts? Tech and telecoms, led by Safaricom, seem to have clear positive momentum.
Definitely. Safaricom's performance and that positive outlook really underscore the potential there, driven by connectivity, digital services, that regional play. It's a key growth engine.
Banking, as we've stressed, is very mixed. Strong results from BK and Family Bank.
But then declines from Stanbic, Stanchart, and even Equity Bank, which was the most traded stock but still dipped slightly.
And Equity had those reports about internal issues too, didn't they? Staff sackings related to suspicious transactions.
Yes, that situation certainly highlights the absolute importance of strong internal controls and risk management for any bank, no matter how big. It's critical.
Energy is another one to watch. Kenjan's geothermal focus looks like a positive indicator for renewables in Kenya.
Absolutely. That shift towards renewables like geothermal isn't just a local trend, it's global. It offers huge opportunities for Kenya, both environmentally and economically.
Then you have traditional media, like Nation Media Group, clearly struggling with disruption.
Consumer goods look a bit mixed, and that potential tourism downturn flagged for Expedia could ripple through the economy.
And agriculture, specifically tea, facing those significant headwinds from global prices and the currency.
Yeah, the tea sector's challenges are a stark reminder of commodity market volatility and currency risk, especially for export businesses.
But on a slightly brighter note for financial services overall, the CMA licensing 2 new fund managers.
Right. That suggests growing demand for professional asset management. More competition, which is usually good for investors, points to a deepening financial market.
And Kenya Power getting the green light to buy transformers.
Yeah, that reflects the ongoing need to invest in the electricity grid to keep up with demand, essential for economic growth.
Okay, so pulling all these threads together, the trends, the sector dynamics, what's the forecast looking like? What are the key factors shaping the near future?
Well, a few things stand out. The central bank rate, having come down from previous highs, will still influence borrowing costs. We saw the impact with Stanbic's increased repossessions, suggesting some borrowers are still struggling.
And the government's budget? There was mention of another amendment.
Yes, the Treasury expecting a third budget amendment due to revenue shortfalls. That points to ongoing fiscal pressure, likely meaning more government borrowing. Government policy is also a factor like the Kenya Power tender approval, showing support for infrastructure.
And global factors.
Huge. Especially for sectors like tea, as we discussed global prices, the shilling exchange rate. Those remain critical external influences. While the sources mentioned U.S. markets weakening a bit, the direct, immediate impact on Kenya wasn't detailed, but global sentiment always plays a role, even indirectly.
So, given all that, the mixed signals, the various pressures, the forecasts, what's the practical advice for listeners trying to invest in this environment?
I think the number one takeaway has to be diversification. Given how differently sectors and even companies within sectors are performing, spreading your investments is just crucial for managing risk.
Don't put all your eggs in one basket, basically.
Exactly, and be very aware of those external risks, commodity prices, currency fluctuations like we saw with tea. Also, keep an eye on the potential impact of any economic slowdown on borrowers' ability to repay loans. That rise in repossessions is a warning sign.
So caution is needed, especially with stocks that have sell or hold ratings with downsides mentioned.
Right. But conversely, look for companies with clear growth stories. Safaricom's expansion, Kenyan's geothermal focus, those well-performing banks like BK Group and Family Bank, those could be opportunities. But, and this is key, always do your homework. Thorough due diligence is non-negotiable.
And for maybe smaller retail investors.
The fact that there are more fund managers now means more unit trusts are likely available. That can be a really good way for individuals to get diversification without needing huge amounts of capital.
Okay, great practical points there. So wrapping up this deep dive, the Kenyan market is clearly complex right now. Lots of moving parts, performance varies widely.
Definitely. And different factors are driving different sectors. It just underscores the need for really informed investment decisions.
And that need for diversification and careful risk assessment seems paramount in this climate.
Couldn't agree more. Balancing risk and seeking out genuine growth opportunities based on solid fundamentals and understanding the broader economic picture. That's the key.
It really is a dynamic interplay between local developments and those global forces. It definitely makes you think about what opportunities and challenges might pop up next as these forces keep interacting. Well, that's all the time we have for this deep dive. A huge thank you for joining us. If you found this analysis helpful, please do subscribe to the deep dive for more insights like this. And check out our social media channels. All the links are right there in the podcast description for updates and to continue the conversation.